Welcome to The Explainer. Today, we're diving into a financial product that seems to promise the absolute best of both worlds. Instant, easy trading combined with those juicy high yields. But what if that whole promise is just an illusion? We're going to unpack a hidden flaw that could turn all that convenience into a very real trap.
This question right here, this gets to the very heart of the whole thing. Seriously, how can a product that you can buy or sell in a literal second be built on top of assets that can sometimes take weeks to unload? The answer to this puzzle is absolutely key to understanding a massive, hidden risk in today's market.
And this whole paradox is perfectly captured by a real-world example, an ETF that trades under the ticker HYG. Now, this fund holds something called junk bonds, which are notoriously slow to trade. But somehow it lets you trade them instantly, just like a share of Apple or Google. And that mismatch? Well, that's where our story really kicks off.
Now, to really get this mismatch, you have to see just how different these two worlds are. On one hand, you've got stocks. You click a button, and you're done. It's all on a central exchange, it's automated, it's instant, easy. But junk bonds? Oh, that is a totally different game. It's an old-school, over-the-counter market. You literally have to get a dealer on the phone and hunt for a buyer. It can be painfully slow and really hard, especially when the markets get a little choppy. And this just nails the core problem perfectly. Since the 2008 financial crisis, the junk bond market has absolutely exploded in size. But at the exact same time, because of new regulations, the dealers, the folks who actually make the market work, are holding way less of this stuff on their books. It's like having a massive flood of water trying to gush through pipes that have shrunk by 70%. Something's gotta give.
So, okay, that brings us back to the magic trick. If the bonds themselves are so difficult to trade, how on earth can the ETF that holds them trade millions of times a day with just the click of a button? How does that work?
Well, the secret is this really clever process called creation and redemption. There's a special group of huge financial institutions, they're called authorized participants, or APs for short, and they do all the heavy lifting. They're the ones who go into that slow, clunky bond market, gather up all the actual junk bonds, and then they swap that entire basket with the ETF provider for a big block of brand new, super easy to trade ETF shares.
But here's the really wild part. Most of the time, that whole complicated creation process, it isn't even needed. A mind-boggling 99% of all the trading in an ETF like HYG is just regular investors, people like you and me, selling our shares to each other on the stock market. This creates this huge liquid buffer that sits between the fast-moving ETF and that slow, grinding bond market underneath.
Now, this system is a marvel of financial engineering, and it works perfectly, right up until the moment it doesn't. The whole thing becomes incredibly fragile during a market panic, when suddenly that big buffer of buyers just, poof, it vanishes.
And this is the core concept we've been building up to, the liquidity illusion. It's that false sense of safety you get when you see your ETF shares trading in a fraction of a second. You feel like the bonds inside are just as liquid, just as easy to sell. But as we've seen, they are absolutely not.
So when panic hits, that cushion of buyers disappears. The only way out is through that redemption process we talked about. But here's the catch. If the APs can't sell the actual bonds because the bond market is frozen, which is exactly what happens in a crisis, they just stop redeeming shares. The exit door slams shut. It's just like the quote says, it becomes the Hotel California. You can check out anytime you like, but you can never leave.
And look, this isn't just some abstract theory. We don't have to guess what happens. We saw this entire illusion shatter in spectacular fashion during the COVID-19 panic back in March of 2020.
Okay, to really understand what happened, you need to know about something called NAV, or net asset value. Just think of this as the official price tag. It's the calculated value of all the individual bonds sitting inside the ETF, based on their most recent prices. But then, you've got the ETF price. And this is a totally different beast. This isn't a calculation. This is pure supply and demand on the stock market. It's what someone is actually willing to pay you for that convenient ETF wrapper right this second.
And in March 2020, these two numbers didn't just drift apart, they were violently ripped apart. While the official NAV of the bonds inside HYG was still relatively high, the actual market price you could get for the ETF just plummeted. People were so desperate to get out that they were willing to sell the wrapper for way less than the supposed value of what was inside.
This kicked off an absolutely terrifying downward spiral. The panic made the ETF price drop.
That forced people to try and redeem their shares, which meant the APs had to try and dump bonds into a market where there were no buyers. That, in turn, crashed the bond prices, which lowered the official NAV, which only created more panic and sent the ETF price even lower. It was a vicious feedback loop.
And here is the absolute kicker. This didn't fix itself. The entire market was on the verge of completely seizing up. The only thing that stopped the collapse was the U.S. Federal Reserve stepping in with a massive, unprecedented bailout. They literally announced they would start buying these ETFs directly.
All right, so this all leads us to the most important question of all. What does this actually mean for you, for investors today? Who is left holding the bag with this hidden risk?
The risk really falls on two main groups. First, you have the retail tourist, who buys something like HYG for that nice high yield, maybe thinking it's just a slightly riskier savings account, completely unaware that there's a trapdoor underneath them. And second, you've got these huge automated funds whose algorithms are programmed to just sell, sell, sell when volatility spikes, which means they become a massive wave of selling at the exact worst moment.
And that's really the ultimate takeaway here. The very thing that makes this product so attractive and easy to use in normal times, that convenient ETF wrapper, is precisely what becomes its greatest vulnerability. In a true crisis, the tool becomes the trap.
And this leaves us all with one final, and frankly, pretty sobering question. The system failed once and was saved by a safety net that no one had ever seen before. So as an investor, you really have to ask yourself, when the next trapdoor opens, will that safety net be there to catch you?